These are the tax rules that millionaires keep breaking that could cost you millions of dollars. I personally have paid a lot of taxes to multiple different countries, mainly the United States of America. I renounced my US citizenship, not for tax purposes, because I had other citizenships. I wasn't even going to the United States for a period of 5 years, and I thought I don't really need the US citizenship, and it's causing a lot of hassle in my life with all the reporting and all the companies that I have to tell the US that I have around the world. So it didn't make sense for me. And now I've optimized my life in the best possible way to pay little tax, not zero, while still enjoying developed countries, while still not living in a country that I feel bad in, while still not having to have trouble sending money around the world. And there's a lot of rules when it comes to taxes. Specifically when it comes to taxes in countries that are aggressive. We're talking about the United States, Canada, UK, all the European Union with a few exceptions. South Africa, for example, is very aggressive. Japan, Mexico, if you live there. There's a lot of countries that will really chase you for taxes. And I want to tell you the tax rules that you should follow. I'm not a tax advisor. I did this for myself. Please, before you do anything, talk to an expert in your country. Talk to a tax lawyer or accountant literally before you do anything. Don't just take advice from this video. This is the stuff that I've done to personally optimize my earnings, my income, my capital gains, my crypto. The first rule that people typically break, and specifically millionaires, is I don't live there 183 days. I don't live there anymore. Therefore, I don't pay any tax. And this happens with countries that have multiple tests in order to determine your tax residency. Mainly in the European Union, places like France, Spain, the UK also applies this, Canada, Australia, for example. They have what's called the Center of Economic Interests, or the Center of Personal Interests. Let's say that you were living in France for a couple of years, and you were paying taxes, and you were paying the ridiculous amount of tax that you have to pay there in France, and then you leave, but you still have a lot of French clients, you still have a French company, you still have French property, even though technically you're living in Dubai, you're not living in France anymore, France can still claim you as a tax resident, specifically if you were a tax resident before, because your center of economic interest, your company, your clients, your properties, your net worth is in France, therefore you're still a tax resident of France. This also happens in Spain. This happens in Canada, where they say, look, you have too many ties to this country. Your wife is here, even though you're living somewhere, maybe you're pretending to live somewhere. Your kids go to school here. You have multiple properties that you don't rent out, and you have them here empty and available to you. Your whole family's here. You have bank accounts with large deposits in our country, and you're just pretending to live there. Therefore, we're still going to claw back those taxes because you're really a tax resident of us. You want to be very careful with having strong ties to any country that is aggressive. Specifically, if you're leaving that place. If you were a tax resident before and you leave and you become a tax resident somewhere else, make sure you have a tax residency certificate, or in the case of US citizens, you renounce your US citizenship, or you really truly move to Puerto Rico, or basically the only tax haven left for US citizens that don't want to renounce is Puerto Rico. So make sure you truly have proof of that, and make sure you also have ties to the new country. If you have a company, if you have clients, if you have employees, if you have property, if you have family in the old country where you're leaving, make sure you take all of that with you to the new country. Don't keep the French company. Move it to the UAE. Don't keep the French employees. Move them to the UAE. Don't keep your wife in France. Move her to the UAE. You truly have to move your life, because these governments are really smart. They're going to see, okay, he's spending 3 months a year here, but center of economic interest, center of personal interest, this guy lives here, tax resident, boom. That's the first one that I see a lot. The next one is, I've moved my company offshore, or I moved my company to Dubai or to anywhere around the world. Therefore, that company doesn't pay tax. If you're living in Canada, for example, with a UAE company, with a Dubai company, if you're living in the UK with a Dubai company, that company is subject to controlled foreign corporation rules, which means that a company that is managed and controlled from a country is taxable in that country. So if you're British and you have a UK residency, tax residency, you're living there 200 days per year. I don't know what's wrong with you if you're doing that, but let's say you're doing that and you have a UAE company. That UAE company will be taxed as if it were in the UK. So the fact that you went to the trouble of going to the UAE, incorporating the company, incorporating the bank accounts, getting your residency means nothing because you are controlling and managing it from the country of residency, from the country that truly is going to tax you on those earnings, sometimes double tax you. You pay tax in one place and then they request the tax in the other place and they don't offer the refund because they think you're evading taxes. And you want to be very careful. Tax is something that, like the Joker and Batman said, I mess with everybody except the IRS. I have a very similar mindset. I do a lot of risks in my life except with tax. Tax has to be 100% clean because the penalties for tax violations, for tax evasion is just horrific. So you definitely want to avoid that. And then the next one that I see with crypto specifically, I don't have to report my crypto because it's not in a bank or it's not in an exchange. Governments are getting very smart when it comes to cryptocurrency. They're getting very smart about who owns the wallet, about chain analysis, about determining when you bought and you sold your crypto. So if you have cryptocurrency and it's in offline wallets, my personal recommendation, even though I'm not a tax advisor, would be to report those assets. For example, in Spain, there is a report where you have to tell Spain that you have crypto wallets outside of Spain. If you're living in Spain and you have cryptocurrency in other countries, I would tell clients, look, it's better if you report it. I'm not a Spanish tax advisor, but it's better if you report it because if they find that the penalties are huge, they can put a punitive tax on that and then tax you on the amount that you've hidden. So you want to be very careful with this. Always report those offline wallets or just move. Don't live in that country. Don't have your center of economic interest or personal interest in that country. Go somewhere else that doesn't care. Go to a place like Serbia. Go to a place like UAE or Paraguay or Panama. That doesn't care if you have offshore crypto. They just truly don't care. Go to these places because you're not going to get away with just hiding your crypto in hardware wallets. That's my personal recommendation. Now, the next one about properties. If you buy property in another country and you're going to hide it there, let's say you buy property somewhere and then you just pretend to never tell your government about it, or you pretend to rent it out and not pay tax on that income, there's going to be more transparency when it comes to real estate. After 2027 and specifically 2030, there's going to be extreme transparency with real estate ownership. They're going to know where you have your properties. They're going to know how much money you make from them. They're going to know how you paid for them. They're going to know how much you paid for them. Every OECD country is going to know this. So just because you go and buy property in Dubai does not mean that your home country is going to not know about it. They will know about it. They will know if you have crypto because of the crypto asset regulatory framework in 2027. They will know about your real estate, specifically 2027 to 2030, because it's going to be transparent. So overall, they're going to know all your assets around the world. My personal recommendation, move your tax residency. If you're a U.S. citizen and you're tired of the U.S., the only way is to renounce your U.S. citizenship. That is truly the only way to protect yourself at the highest level because it's just going to be also transparent. Go to countries that are not part of CRS, that are not part of these asset reporting frameworks. The next rule would be misusing residency and also citizenship programs with short-term tax residencies or lower taxes. For example, if you're Canadian or British or Spanish or whatever, and you get a Caribbean passport, a St. Kitts, Antiguan passport, these countries are tax-free. I'm a St. Kitts citizen. If I decide to go live in St. Kitts, then I'm not going to pay taxes to St. Kitts. But it doesn't mean I pay taxes to St. Kitts because I'm a citizen. It depends on the country where you live. So getting another passport while still living in your high-tax country does not remove the tax liability. I think getting a second passport is the best idea you can possibly do. There's going to be more capital controls. There's going to be restrictions on your travel. So they want to cancel your passport if you spend too much money on whatever they decide is bad for you. There's going to be extreme transparency. So at least you can get some privacy by having another citizenship in a place that doesn't bother you that much. And you have another country that you can potentially live in, open bank accounts, open companies, and so on. But the fact that you get a tax-free citizenship does not mean that you're not paying taxes to your home country. It matters where you live, where you have your center of economic and personal interest. And also, Short-term tax residency programs, for example, Cyprus, has a 60-day tax residency program, and it's a very low tax rate comparable to other countries. You're paying around 10% versus 50% in some other countries. There is a rule in Cyprus that you cannot be tax resident of any other country. So if you spend 200 days in a country and you're clearly tax resident there, and then you go to Cyprus and you spend 60 days to get your tax residency certificate, that's not going to work because you can't be tax resident anywhere else. And that country can just cancel that tax residency request in Cyprus by saying, look, you truly live here. Your ties are here. We have all the evidence. You're not living in Cyprus. You're not going to get away with this. And that is one issue that I see people saying is, oh, I have residency in Dubai. I'm going to go once every 6 months. I'm a tax resident. No, it depends where you live, where you have your center of life, and where you're actually spending most of your time. That's what matters. We talked about controlled foreign corporation rules. Basically, if you're living somewhere and you have a company somewhere else, even if they don't have CRS, a lot of people do this with US LLCs. They're living in a high-tax country. They open a US LLC. They receive money there. They keep it there. And they don't tell their home country. That is tax evasion and tax fraud. You want to be extremely careful with that. But also this happens with trusts and foundations as well. So somebody will be living in a high-tax country or will have their center of life there. And then it's going to move all their assets over to a trust, all their assets over to a foundation, all their assets over to a USLC, Dubai company, whatever, and then pretend that they don't own those assets anymore. High-tax countries can pierce that veil, can pierce that ownership and say, look, that money that you moved to that trust, we know it's yours. Maybe it's hard for them to find out about it, but they will. These governments have so much money. And when they find some red flags about somebody, oh, his wife lives there, he has big bank deposits, he spends here a lot of time, show me your bank accounts, let's see if you actually spend time in this place because of your transactions. And also, you don't want to mess around with that. A lot of people are doing that with Puerto Rico. I'm from Puerto Rico, and I've seen this happen where people pretend to live in Puerto Rico by giving their card to somebody, and that person will just spend there and say, oh, look, I live in Puerto Rico. Yeah, dude, but you have transactions also from Miami, from New York, or we check the flight logs, which governments do this. They check the flight logs to see where you actually were. That's undeniable proof that you were there. And if you fly private, they can check the private flight logs. You can ask Shakira about it. Spain check her private flight logs to see where she was actually going, her concerts and so on, because she was pretending to not live in Spain, and they actually caught her, and she was more than 200 days in Spain because the other things, her kids, her utility bills, her house, and so on, were in Spain. So you want to be very careful with moving your assets overseas, moving your assets offshore. If you're personally not moving, that is a recipe for disaster. And the last one that I'm going to mention here are exit taxes, not being aware of them specifically. For example, the US has an exit tax when you renounce. Canada, deemed disposition tax. The UK wants to launch a 20% exit tax. A lot of EU countries have high exit taxes. When you leave the tax system and you show your tax residency certificate of another country, you show your ties to another country, you say, bye, I'm out, I don't have any ties here. A lot of times, they will ask you to pay an unrealized capital gains tax. Essentially, if you bought Bitcoin at a very low price and now it's a high price, you don't want to sell it, they're going to tax you as if you sold it. You have a business that you started, now it's worth $10 million. They can say that business is worth $10 million, pay us a 20% exit tax, even though you don't have 2 million, 20% of 10 million. You don't have 2 million in cash. You don't have $2 million. The company's worth 10 million because the government determined it is. And now you don't have 2 million to pay the tax to leave the country. So you have to be very careful with exit taxes, specifically in countries that you built up a lot of history in that are high tax, because this can break you. A tax on unrealized capital gains, when you don't even have the money to pay that, that can financially bankrupt you. So you want to be very careful. Sometimes it makes sense to delay the move or speed it up. You get out of your country ASAP because you know that your shares are going to go up, or your value is going to go up, or that company is going to go up. Somebody's going to invest into it and so on. That's why a lot of people renounce US citizenship before receiving a large payout, before receiving shares in a company that goes in IPO, or before they sell their crypto, because they know, look, my crypto is going to go up 10x in the next year. I'm going to renounce right now. Legally, you can avoid the tax on the next year after renunciation gets approved. because you're not a US citizen anymore. Obviously, as a US citizen or an ex-US citizen, don't go live in a high-tax country because you're going to pay them, but you have to optimize this clearly. So be very careful with exit taxes and unrealized capital gains taxes. Those can really break you. If you want to see the countries that my wealthiest clients are going to for more freedom, less taxes, better lifestyle, you can check out this video right here on the countries my clients choose, and I'll see you on the next one.